Okay, let's start. So, our topic for today is Circular 230. Circular 230 is basically gives you the rules and regulations if you are a someone who is practicing before the IRS. Okay, it outlines the ethical rules, responsibilities, and sanctions for tax professionals such as CPAs, attorneys, enrolled agent, and others who are basically doing practice before the IRS. They are representing taxpayer, then they have to follow certain rules and regulation which is given under this circular 230. So who must follow these circular 230? It must be followed by the person who are practicing before the IRS, as I told you, like CPAs, attorneys, EA, enrolled agent, enrolled actuaries, enrolled retirement plan agents, any individual who is providing written tax advice intended for IRS reliance. Okay, so what are the duties and restrictions? So must provide competent representation, must exercise due diligence. So as a professional, you must have to provide the competent representation, means you should have proper knowledge. You should exercise your duty with proper due diligence. When preparing tax return and documents, means you have to follow certain rules. You should not give any false and misleading opinions to anyone who comes to you to regarding some opinion or any. If they comes to you to prepare some tax return, then you should only provide such opinion, and you should uh, only give such opinion which are actually exist. Do not give false or misleading opinions. Must avoid conflict of interest unless disclosed and consented. So, conflict of interest means like if your interest is conflicting somewhere, you need to disclose and also need some consent. For example, if a couple comes to you to file their tax return, and that couple get divorced, and both who are comes to you to file their tax return, then in that case there might be some conflict of interest. Okay, so you as a tax professional, you need to disclose to them first and need their written consent before preparing their tax returns. Okay, must promptly return client record when requested. So when a client requests to you to give them their records, you need to give them. You can't retain their record just because of some reasons. Okay, must charge reasonable fees, like contingent fees are not allowed. Next is standard for written advice. So tax professionals must ensure written tax advice should be based on reasonable factual and legal assumptions. So if you are providing some kind of tax advice, so that advice you are providing, that should have some relying, some meaning. It means it should be based on some reasonable factual and legal assumption. Do not rely on unreliable or incompetent information, like if you are not sure about something, or if you do not have like proper knowledge of something, that you should not give them as advice. Consider all relevant fact, laws and authorities before giving any advices. Okay, any doubt?
No, ma'am.
Next is sanctions under circular 230. So if a practitioner violate the rule, the IRS Office of Professional Responsibility can impose penalties such as censure, suspension from IRS practice, disbarment, monetary penalties. So if you are violating certain rules, then you have to subject to certain kind of penalties, certain kind of punishment from the IRS, like your license may be suspended, your license may be suspended, you have certain monetary penalties, you may be disbarment, means you can be put behind the bars if you are violating certain kind of rules. Best practice for tax advisor. So clearly communicate the engagement terms. Establish appropriate procedure to ensure compliance. So as a tax advisor, you need to have clearly communication regarding your engagement term. So in future, if like to avoid any conflict between you and your engaging party, so to avoid that, you need to have clearly communication with them. You need to establish procedures to ensure the compliance. Document assumption and factual representations. Next is present issue clearly and accurately to clients and the IRS. Example: a CPA issues a written tax opinion spotting a complex deduction. The CPA must verify fact, research relevant law, and ensure assumptions are reasonable. If the CPA relies on questionable data without verification, it may trigger 230 sanction for lack due diligence. So, for example, if someone comes to you regarding certain tax advice and you are giving certain tax advice on any complex matter, and even you are not sure about that advice, or you do not have any like reasonable laws and assumptions, so as a CPA you should not give such advice, because it might question your profession. Okay, it it will be a lack of due diligence for you. Next is authority to practice. So who may practice before the IRS? So first of all, our circular 230 gives us the give us the criteria, like who people are can be practiced before IRS. So if you are someone who is an attorney, CPA, and enroll agent who are in a good standing with their license authority, means your license is not somehow is suspended or revoked, then you can practice before the IRS, unless or until your license is suspended by the IRS or revoked by the IRS. Enrolled actuaries and enrolled retirement plan agent may practice within the limited scope. Registered tax return preparers, if reinstated, have limited practice right. Okay, so if you are a tax preparer and you have a registered with IRS, then you can practice before the IRS. Individual with a recognized power of attorney may represent taxpayer for a specific matter. Okay, so requirement for practice eligibility, as I told you, if your license is somehow is not suspended, or you are not disbarred or under restriction by the IRS, then there is no problem. You practice before the IRS. But in case if your license is suspended or revoked by the IRS, then in that case you can't practice. Must satisfy all competency requirement, like you should have proper education, must comply with the rules regarding conduct, diligence, and ethical standards. So if you are a practicing, then you need to follow certain rules and regulations. Okay, any doubt till here? Any doubt? Any doubt?
No, ma'am.
Okay, so next is limited practice before the IRS. Like if someone is representing their immediate family members, full-time employees representing their employers, or if you are a fiduciary, like a trustee, executor, or administrator representing the entity they serve, then in that case you will not consider as a tax practitioner. Okay, so if you are a someone who is just preparing the tax return for your friend and families, then in that case you will not be considered as a tax practitioner. Okay, Next is application for enrollment. So you must pass the special enrollment examination or meet the experience criteria, must undergo a background and tax compliance check, must pay enrolled and renewal fees. Okay, so these are certain requirements that you need to fulfill. You need to clear some examination, some background check, and need to pay certain amount. Okay, suspension or termination of practice right. So failure to comply with tax laws or circular 230 provisions can lead to disciplinary action by the OPR. Okay, if you fail to comply with these laws, then obviously you lead to disciplinary actions. Ground include conviction of tax-related crimes, misconduct, conflict of interest, or knowingly giving false tax advice. So, if you are breaking these laws, like if you are someone who is involved in tax-related crimes, you are misconducting your profession, or you have certain conflict of interest, or knowingly you are intentionally giving some false advice to your clients, then in that case uh, you will be subjected to the action by the IRS. Your license may be suspended or disbarred. Practitioner may not assist, advise, or represent the taxpayer before the IRS. So in that case, your license may be suspended. You are put behind the bars, or you may subject to certain penalties. Or if your license is suspended, then you may not able to assist or advise someone, okay, and not able to practice before the IRS. Any doubt?
No, ma'am.
Okay. Next are certain examples are given. For example, a CPA who is licensed and in good understanding may represent the taxpayer before the IRS. A taxpayer brother who is not a CPA or EA may represent before the IRS for her tax audit under the limited practice rule, but must not accept the compensation. Okay. Next is duties and restrictions related to practice before the IRS. So if you are practicing before IRS, then you need to fulfill certain duties and certain requirements. Like you must provide competent representation to your clients. They must activate due diligence when preparing, approving, or filing tax returns. So whatever you are doing, you are preparing, approving, or filing the tax return, you need to follow the due diligence. Okay. They must promptly submit record and information requested by the IRS. Due diligence requirement means practitioner must verify accuracy of statement to the IRS. Like you should not fill the you should not fill the false statements. You should not like fill your tax return having so much error. So you need to maintain your due diligence. Cannot ignore implication of information furnished by the client. You must exercise care in determining the correctness of oral or written representation. So whatever the representation you are doing, you need to maintain the due diligence. Okay. Information request. So must promptly provide information requested unless privileged. So whatever the information IRS want from you, you need to give them the requested information. But if it is privileged, it will be okay if you are not giving. But unless or until it is privileged, you need to give it to the IRS. Must advise client of non-compliance, error, or omission. So if you are finding certain errors in like previous tax return of your client or in current return, then you can advise them about these such non-compliance or error or omissions. Must promptly correct error when authorized. Okay, so if the client is asking you to correct certain error from their previous return, then you can correct them also. Next is conflict of interest. So As I told you that if there is a conflict of interest between you and your client, then first is you need to disclose them. Second, you should need a written consent from the affected client. Okay. Example I already give you, like if couple, a divorced couple is come to you and both are requesting you to file their return. In that case there might be certain conflict of interest, like you maybe you have good friendship with the male, uh, s- but in that case that means your interest can be conflict with the other spouse. Then uh, your duty is to first disclose them, and second you need written consent from both the parties. Okay, next, fees and compensation. So contingent fees is not allowed. Okay, so if you are uh, taking certain fees which is based on certain result, like you are asking them that you will get you will able to give them a good refund, and that's why you are charging the high amount, that will be not okay. But certain IRS proceedings, for certain IRS proceeding it is allowed, like uh, if you are like putting certain conditions, like if which are actually you are not sure about, then in that case you can charge them fees, or if it is authorized by the state, then you can charge the contingent fees. Okay, so next is advertising and solicitation. So advertisement must not be false, like if you have a certain CPA firm, or you are practicing as a CPA and you are putting certain advertisement, then that advertisement should not be false, fraudulent, or misleading. Like for example, you are putting that you will be able to get highest refund if the client and comes to you to file their return, then that should be not there. Okay, so you not participate in any use of any public communication containing a false, fraudulent, or misleading statement or a claim. Must disclose limitations and qualifications. Okay, so you as a practitioner you may not make an uninvited written or oral solicitation of employment in matters related to the IRS. Standard for tax return and documents. So you cannot advise a taxpayer to take a frivolous position, means position which has a not a reasonable meaning. Okay, which actually does not have a spotting statement. So you not advise your client of such position. Must ensure position has realistic possibility of being sustained. Okay, and must inform client of the penalties likely to apply. Okay, if you are finding that certain penalties may be applied, you need to disclose to your client. Incompetence and misconduct, like include conviction of tax crime, giving false information, willful failure to the file return, may lead to suspension or disbarment. Okay, if you are misconducting your profession, then in that case you may be subjected to certain penalties and certain punishments. Okay. Okay. Any doubt till here?
No, ma'am.
Okay. Next is standard for tax returns and documents. So standard for tax returns. So practitioner must not willfully or recklessly understate the tax liability. So if you are a tax preparer, your duty is to reduce the taxes, but not to completely eradicate the taxes. Okay. So you not willfully or recklessly understate certain tax liability. Whatever the position you are taking, like whatever the deductions you are taking, whatever the credits you are taking, you should have proper adequate spot of that. You not mislead any deductions. Okay. So these are certain standard is given, like reasonable basis means, like if you are taking certain position on your return, then in that case, if it has a reasonable basis, that means if it has more than 20% of chances that it will be spotted by the IRS, then in that case your penalty will be avoided. Okay, so if you have certain undisclosed position and you want that you have taken that position and you want that you to avoid the penalty, then in that case there should be more than 20% chances, that means it should have reasonable basis that it will be spotted by the IRS. Okay, similarly for undisclosed return, if you want to avoid the penalty, that in that case there should be 40 to 50% chances, like more than 40 to 50% chances that it will be spotted by the IRS and it have a substantial authority. Okay, or if you are a tech shelter and you are like doing certain transactions to avoid the penalties, then in that case there should be more than 50% chances that it will be spotted by the IRS. Okay, to avoid the penalties. Next is standard for documents and papers. So a practitioner must not submit document intended to delay tax administration that are frivolous or contain information known to be incorrect. Okay. So if you are submitting certain document, then in that case the document should be proper. You can't just submit the document which are actually incorrect or frivolous. Reasonable reliance means a practitioner may rely on information from client or third party if reliance is reasonable. They cannot ignore obvious error. Okay. So as a practitioner, if the client is giving you certain records, so by default you are accepting that these records are okay. But if you are finding certain errors in that errors you can't really ignore them. Okay. Advising client on errors. So if the practitioner discover an error or return on a return or submission, they must inform to the client. Okay. For example, in the previous tax return, you are finding certain errors which can lead to penalties on the client. That in that case, you need to disclose these errors on the client to the client, and also you can inform them the whatever the consequences it may be having. Okay, your duty is not to inform to the IRS. Your duty is to inform to the client only. Okay. Okay. For example, like your client has certain deductions which they have taken in the past without the receipt. Filing a return claiming tax is unconstitutional, is frivolous and prohibited. Practitioner find overstated depreciation in the prior years. So whatever the error or you're finding, you must inform to your client. Okay, any doubt? Any doubt till here?
No, ma'am.
Okay, next is written advice. So Circular 230 is also give you standard for providing written tax advice. So in case if you are providing a written advice, it requires practitioner to use reasonable diligence, consider all relevant fact and not rely on unreasonable representation. Okay. Written advice may include emails, memos, formal opinions, and other written communication about the tax matters. So in case if you are providing the written advice to your client, so that written advice should be based on relevant fact. Okay, you can't really give them the advices which do not have any reasonable presence. Okay, key requirement for written advice. So first is due diligence. So when you are giving the written advice, like you are working as a tax advisor or Other than in that case, you need to fulfill certain requirement, like first is due diligence. Okay, so the practitioner must make reasonable effort to identify and ascertain all relevant facts. They must reasonably evaluate assumption and representation made by the taxpayer. They must rely on information from the taxpayer unless it appears to be incomplete and incorrect. Okay, so first is your duty to maintain the due diligence. That means you remain alert to the errors if you are finding. Otherwise, you need to just rely on the information which is given by your client. Consideration of laws and fact. The practitioner must apply relevant tax law to the fact in the competent manner. Must consider potential penalties and ways to avoid them. So, if when you are providing certain advice, then your duty is to remain competent to the you need your duty is to maintain the competent requirement. You need to consider that if you are finding certain penalties, then you need to consider the ways that you can use to avoid them. Advice cannot be based on unreasonable assumptions. No unreasonable reliance means you can't really rely on information that appears implausible or inconsistent. Okay, so by default, you are actually assuming that the client is providing you the correct information. But in that case, if you're finding the obvious errors that you can't really ignore them, then in that case, you do not rely on the information. Cannot rely on representation without verifying the when the circumstances require the verification. No conflict with law or ethics. So you not promote any tax evasion or abusive transaction. Okay. So your duty is to provide them advice that they can reduce their taxes, but you should not promote the tax evasion. Like you are really just avoid evading your the taxes. Okay. So practitioner must avoid giving advice that could be used to improperly reduce the taxes. Okay. So for example, acceptable written advice. So a client asks whether their specific business expense is deductible. So if the business expenses is deductible or not, so as a practitioner, you first request the receipt and documentation. Then you can search for the IRS standards regarding the expenses, confirm the expenses ordinary and necessary. Only then you provide your advice to your client. Okay, so if you are finding that these expenses, like for example, your client comes to you and asks you to get 100% business meal deduction, so you know that for business you only get the 50% deduction only. Okay, so in that case you can't advise the client to take the 100% deduction because it is not allowed. Okay, any doubt?
No, ma'am.
Okay, next is unacceptable written advice. So a client asks you to classify personal expenses as business expenses. Okay, so a client asks you that they want to deduct their personal expenses as a business expenses in their tax return. So since you know that your personal expenses is not deductible, so in that case you need not to advise the client to take the deductions. Okay, the practitioner simply agreeing in writing without the reviewing documentation. So if since the personal expenses are not allowed to be are not deductible, but if you are intentionally or by knowingly you're giving them the advice and you are agreeing in writing without reviewing the documentation, then in that case there is a tax evasion which is uh, due to taking the frivolous position. So in that case, practitioner relied on unreasonable assumption, did not evaluate the fact, and advice facilitate improper tax reporting. Next is penalties for non-compliance. So if you are not complying with the laws and regulation, then in that case, as a practitioner, you may be subjected to suspension or disbarment from the IRS practice. You may subject to certain penalties. Violation may trigger the IRS Office of Professional Responsibility investigation. Okay. So next, compliance again. Procedure to ensure compliance. So first is for reasonable, responsible individual, means the people who have principal authorities over the tax practice or supervision and must implement and ensure compliance procedures. Required procedures means you need to follow due diligence, conflict of interest check, competency and training requirement, written advice standard, and protection of taxpayer data. Firm level liability means firms are liable if procedures are not implemented, inadequate, or ignored. So, if you have certain CPA firm who is providing the tech services, then your firm also need to follow certain standards. Supervi- Supervisor liability. So, supervisor who know or should know of violation and fail to act are also liable. Examples: failure to implement due diligence procedure result in firm liability. Okay, so if you are not following your firm employees are not following the due diligence, then in that case your firm may be subjected to liability. Supervisor ignoring non-compliant employees violates section 10.36. Proper procedure protect the firm from penalties even if an employee commits the fraud. Okay, so in case if an employee commits certain fraud, then your firm can be protected from penalties. Okay. Compliance checklist. So written policies. There should be certain written policies, supervisory review, training, data protection, due diligence, written advice review, and disciplinary system. Okay, so all these may be necessary to be complied with the laws. So next is Circular 230 subpart C. It gives you sanctions for the violation. So in case if you, a taxpayer is violating certain rules and regulations, so they may be subjected to certain punishments, certain penalties. So OPR means of IRS Office of Professional Responsibility may discipline practitioner for incompetence, disreputable conduct, or willful violation of Circular 230. So type of violation means if in case if you are incompetent, like for example uh, you are claiming as a CPA even if you are not you do not have proper license and you do not have all the your members in your firm as a CPA, and still you are uh, putting in your advisement or certain other things that you have all CPA members. Okay, disreputable conduct means uh, you are conducting certain crimes, tax crimes, failure to file returns, false statement, anything that is disreputable conduct or mislead your professions. Willful violation, failure to comply with subpart B duties. Okay. So type of sanctions. So you may be subjected to disbarment, be minimum for 5 years. Your license may be suspended, censor, monetary penalties, and additional restriction or training. Disciplinary processes means investigation, administrative law judge hearing, decision and appeal, and reinstated after the 5 years. Okay, so for example, some of your penalties or your punishments are given, like if you are failed to file the return in a timely manner. Okay, or as a taxpayer, like you are providing the tax services to your client, you are preparing the tax return, and still you are not even filing your tax return of yourself, then in that case there is a violation and you may be subjected to suspension and disbarment. Endorsing a refund client, like you are taking the refund check of your client, because they have not paid you your fees or maybe something, then it you may be subjected to the suspension. False advice for abusive shelter. Okay, if you are providing the false advice, then you may be subjected to disbarment. AITC due diligence failure, in that case, you are subjected to the penalties as well as censure. Firm instructing employees to ignore rules, so you may be subjected to the your firm may be subjected to the firm liability. Okay, so AITC means earned income tax credit. Any doubt? Any doubt?
No, ma'am.
Okay. Next is petition for reinstatement. So this section basically gives you the outline the process by which suspended or disbarred individual may seek reinstated to practice before the IRS. So for example, if you are a person who is suspended, your license is suspended or you are subject to some disbarment in the past, then now you are going to re-practice before the IRS, then in that case you have to subject to certain uh, processes. When petitions may be filed, so if you are suspended, then after suspension term, like once your suspension term is over, then you can file for reinstatement. Disbarment after 5 years. Voluntary termination, so anytime if no pending action is required. Okay. Requirement, you need to have written petitions, details of prior sanction, and evidence of rehabilitation, proof of tax compliance, and spotting documents. So all of these are required when you are going for reinstatement. Review process. So once you file for reinstatement, then IRS will review your initial first do your initial review, then investigate, and then written decision. OPR evaluation factors. So these processes will be based on this seriousness of misconduct, like whatever you have done in the past, how much serious the matter was, time elapsed, so how much time is elapsed since you done detect, compliance with tax laws, rehabilitation evidences, and risk of future violations. So all of these will be considered by the IRS. Next, possible outcomes. So they may approve your reinstatement. Okay, so they may allow to re-practice before the IRS. Denial, they may deny. They may do certain conditional reinstatement. Okay, they may give you certain, they may apply certain conditions, certain restrictions on you. Rights after reinstatement, so you may get full or conditional practice rights, ongoing duty to comply with the circular 230. Okay, so for example, a disbarred EA on January 1, 2020 may apply on January 1, 2025. Okay, so as I told you that in case of disbarment, you can reapply after 5 years. So since 5 year has elapsed and this EA has reapplied with the proof of rehabilitation and compliance. Okay. Any doubt till here? Any doubt? Any doubt?
No, ma'am.
Okay. So next topic is professional responsibilities and tax return preparer penalties. So first is tax return preparer. So if you are a tax return preparer, then in that case, what is your professional duties? So a tax return preparer is a person who basically prepare the tax return for compensation or employ others to prepare or all substantial portion of federal tax return or claim for refund. Okay. So a tax return preparer is basically the person who prepare the tax return for the compensation. Okay. In case you are just preparing the return for your family and friend, in that case you are not a tax return preparer. Types of preparer: signing or non-signing. Signing means who has primary responsibility for the substantive accuracy of the return. Okay, so who is assuming the responsibility of whatever the position is taken on the return. Non-signing means who do not have the substantial responsibility, who do not have the primary responsibility basically. Excluded individuals. So if you are just volunteering, means you are preparing return for free, so you are not considered as tax preparer. An employee who prepare return for the employer, person preparing return in a fiduciary capacity, or person providing clerical or mechanical assistance like just doing data entry or typing. So in that case you will not consider as the tax preparer. Substantial portion test means a portion is substantial if it is in large in relation to the total return, or it involves item that contributes significantly to the tax liability. Okay, so any uh, any items which you have shown in your tax return and which has a relation with the whole return, or which is significantly affecting your tax liability, so that is called the substantial portion test. Okay, next is tax return preparer compliance penalties. So since as I told you that you have to fulfill certain compliance requirements, so if you are not fulfilling that, you may subject to certain penalties. So types of compliance penalties: first is understatement of tax liability due to unreasonable position. Okay, so if you are un, uh, taking certain position which are actually unreasonable, and due to these position your tax liability of your client is reducing large enough, or like this is a understatement of tax liability, then you may subject it to the penalties. So it apply when a tax return preparer takes a position lacking substantial authority. So you may subject to $1,000 penalty or 50% of the income derived from preparing the return, whichever is the greater amount. Okay. So this is the penalty amount. A position is considered unreasonable unless, so as I told you that unreasonable, it is considered unless it has substantial authority, means it should have more than 40 to 50% chances that it will be approved by IRS. It is disclosed and has a reasonable basis. Okay, or if in case like it is a tax shelter or reportable transaction with reasonable belief of more likely than not correct. So we already discussed that in what case you can avoid your penalty, like if is a it has a reasonable basis for undisclosed position, or if it has a reasonable basis, or if it has a substantial authority. Okay, in case for tax shelter, then it should have more likely than not, means there should be more than 50% chances that it will be approved by the IRS to avoid the tax penalties. Okay. Understatement due to willful or reckless conduct. So if our preparer intentionally disregard rules or knowingly prepare a false return. Okay. If you have prepared certain return which is actually false, then you may subject to penalty of $5,000 or 75% of income you are earning for preparing the return. Willful conduct involves intentional wrongdoing. Reckless conduct involves ignoring obvious fact. So this is the penalty which will be charged when you are intentionally preparing the false tax return. Okay. In this case, if you are taking certain position which is unreasonable, then this penalty. In this case, if we are preparing the tax return which is actually false, then you may subject to this amount. Next is failure to furnish a copy of tax return. So as a tax return preparer, your duty is to maintain your documents. Like you need to maintain a copy of return. If you are fail to provide this completed copy of return to your taxpayer, then you may subject to the penalty of $50 per failure or up to $27,000 per calendar year. Failure to sign a tax return. So if you are not signing a tax return, then you may subject to penalty of $50 per return or up to $27,000. Failure to furnish PTIN number. So as a tax preparer, you need to have your PTIN number. So in case if you are not able to maintain or if you are not able to include this number, then you may subject to this penalty. Okay. Negotiation of taxpayer refund check. So preparer cannot endorse or negotiate refund checks. So you can't keep the check of your clients, refund check of your clients. So if you are doing this, then you may subject to a penalty of $510 for each violation. Failure to keep record. So as a tax preparer, you need to maintain the record for 3 years. So if you are not able to maintain for this time period, then again you may subject to the penalty of $50. It goes up to the $27,000 per year. Aiding or abetting understatement of taxes. So applies to any person like who is assist in understating the tax liability. Okay. So any person who is just assisting someone to avoid the tax liability, then he may subject to the liability of $1,000 for individual, and in case of corporation, it is $10,000. Any doubt till here?
No, ma'am.
So, for example, a preparer claims a deduction that has no substantial authority. So that means if there is no substantial authority, then he may subject to certain penalty. So taxpayer understatement attributable to this position is $10,000. So penalty will be $1,000 because it will be greater than 50% of the fees earned. Okay, so suppose they are earning $10,000. So 50%, sorry, suppose they are earning approximately of $1,000. So 50% of the income you are driving or $1,000, whichever is the greater amount, you may subject to the penalty of that amount. Next is willful or reckless conduct. So a preparer knowingly inflate expenses to maximize a taxpayer refund. So he is um, intentionally inflating the expenses, like showing more expenses than actual to avoid the taxpayers uh, liability and to maximize the refund. Then this penalty again, it will be $5,000 or 75% of the fees earned. So whichever is the greater amount, penalty will be applied. Okay. So this was all about your tax return preparer. So what are the basic duties as a tax return preparer, and if you are not able to fulfill these responsibilities, then you may subject to these penalties. Okay. So depending upon your course of action, IRS has different penalties for you. Okay. Any doubt till here?
No, ma'am.
Okay. So from this, we will continue tomorrow from this onwards. Okay. Okay. Just a minute. Okay. So compliance part we already discussed. So it is by mistake, it is again mentioned in your slide. So that means we already covered these slides also. So we are only left with two or three slides only. So we will discuss it tomorrow along with certain questions.
Okay, ma'am.
Okay, so if you have any doubt, you can ask. Otherwise, let's continue tomorrow.